Simon, it's great to have you on InvestorStream for the first time as Fremont's recently appointed chairman. The company's reported two positive announcements this week where improvements to the performance of the MHP leases are forecast to yield you something like $140,000 US in additional monthly revenue. Can you talk us through how you're achieving this?
Yes, Alex, thanks for having us on. Essentially, what we've currently working on is an asset that's somewhat been forgotten within the MHP stable. It's the KJ pipeline tie-in that you're referring to, of course. When we bought the MHP asset, not only did we acquire a large number of producing wells and a great deal of potential in the reservoir beneath the surface of the land, we also acquired a fantastic team of people. And really, this tie-in is an example of those people, their motivation being unleashed and them working on what has been a neglected asset within a much larger company that wasn't attracting the capital that it deserved. When we bought the MHP asset as well, I think it's important to note that we paid a very, very, very cheap price. If you look at what the asset traded for 10 years ago, which was many, many, many multiples of what we paid for it, that really was an indication of the value that was in the MHP assets, and we're just starting to realise that now.
So you've said there's a lot of opportunities like this pipeline replacement and well tie-in projects like this. Can you just give us a flavour for what's to come?
Yeah, well, when we did our due diligence prior to acquisition of the asset, obviously a deep dive through the assets and their potential, and we identified a whole range of opportunities, some which address the top line in terms of revenue growth, and you've already seen a little bit of activity and contribution from us in that regard. And then there are other ones which are a product of cost improvement and judicious application of capital. And this one, I would say, is a combination of the two. For a cost of around about $25,000, we're going to achieve a payback in less than a month in terms of the production growth that results from the activity. As I say, we're still in the process of getting underneath the skin of the company. Early indications are that our due diligence is, in fact, only a portion of what's potentially available to us in terms of both sales growth and cost savings. And you'll hear a steady stream of information from us in coming months as we bring some of those projects to fruition.
Simon, today's announcement also states that something like 90% of your wells are productive or have potential to be more productive. Presumably the work you're doing now is to improve the performance of the producers. Is that correct?
Yeah, that's correct. I think one of the unfortunate misunderstandings about the MHP asset when we acquired it was seen principally as a plug and abandonment liability. In actual fact, that is not the case. Some 90% of the wells are productive. That's not to say that they won't benefit from some stimulation, workover and production optimization efforts. But this idea that there's a massive P&A liability simply isn't accurate. There's around about 10 wells that we're required to P&A each year at the behest of the Kentucky oil and gas regulator. We'll be prosecuting that work, and the cost of each of those wells is going to be somewhere between $5,000 to $20,000 per well. So really the P&A liability is rather modest on an annual ongoing basis, and is eminently manageable with the organic cash flow that we currently produce and that we hope to grow, obviously, as we move forward. We're soon going to be publishing our reserves report, and I think that also will give you investors a chance to understand where the MHP asset lies in terms of its contribution to the company, both today and on a going forwards basis.
Excellent, Simon. So before I let you go, what's next in terms of near-term value catalysts?
Well, look, I think we're just getting started. We've added some key external members to the team in the finance capacity. You've seen our ability to renegotiate gas sales to take advantage of an improving macro environment with the gas market. Oil is just starting to head into new territory. WTI is at prices we haven't seen now for several years. So I think most of our focus up until now has been on low-hanging fruit in our gas inventory. I think as we go forward, we really want to see what we can do to maximise our exposure to the improving oil price. So I think you can expect to see a more application of effort and news flow around that. Already we've shared with the market what we're intending to do with the inventory that we've built up over recent months and selling that down to take advantage of the prevailing spot price. So yeah, there's going to be a shift in emphasis in the near term from gas to oil. And as I say, we're going to continue this predictable theme of improving our top line on the revenue side and also working in the background to achieve cost savings and economies across the enterprise and continuing to prosecute work programs out of organic cash flow so that we're not coming back and asking investors for more money for that specifically. And really just watching this opportunity set unfold, we really feel that we've only just touched the surface of the potential, and we're very, very excited about what lies ahead of us. The huge opportunity that we identified with the MHP asset base is just starting to bear fruit. It's a very exciting time for Fremont right now.
Thanks, Simon. Thanks for joining me, and all the best with the future developments.
Many thanks, Alex. Thank you for your time.